Greetings, everybody. It is Sunday, February 8th, 2015, and welcome to this edition of the Weekend Trader. I was hoping to maybe get this out yesterday, but life intervened in a good way. Was doing some things on the personal front and also decompressing a bit from a fairly extensive and exhausting week with Jelly Trading Team number 12. So again, welcome. We're going to try to remain faithful this year and get these out every weekend. The markets are closed. One of the few opportunities in a world where the markets are open almost 24 hours during the weekdays. One of the few opportunities we have to take a step back, breathe, assess last week, assess our performance, assess our careers, assess our lives a little bit. Just use this opportunity to kind of reset the engine, if you will. So again, thank you for your interest in this. Feedback continues to be such that it seems to make some sense. We're kind of getting back to the days of the late 2000s where becoming more active here, Twitter count up, YouTube views of this up. And as long as I continue to get feedback that this is somewhat helpful, I'll continue to make that effort. So I think what I'm going to do today is as we've done in past years on the heels of a trader training effort, is I'm going to direct some of my messaging to the team that was with me over the course of the last week. But also allow the overall trading population that obviously was not part of the team to listen and look over our shoulders, if you will. That's always been the intent of this blog, even going back to my diary days. So we're going to continue to do that and do that a little bit more in depth today. So first of all, I want to thank the group that basically trusted their trading lives with me over the past week. It was a welcoming effort, outstanding effort from my perspective. In that I too benefit from these. It gives me an opportunity to continue to sharpen my own skills and sharpen my own focus when I'm working with a small apprenticeship type of group, and I thank you for that. I am still getting feedback from all of you who participated. We for the larger group, we send out a survey after we do each one of these, get objective feedback. What are we doing well? What can we do different? Does it still make sense to do these? Let's grade certain things, and we're still getting those back, but the feedback seems to be along the lines of what it has been in previous efforts, which is the value still seems to be there. So as long as that is the case, we will continue to go at this. As I said before, it's not perfect, but when I made the decision to get back into some trader training a few years ago, it was important to me to do it right, and the only way I can think about doing that is live over an extended period of time and actually trading. So that continues to be the intent to the extent that we do this over and over again. Maybe once a year. That's the idea. So we'll kind of table that for the moment. But again, thank you, appreciate that. One of the things that we did was look back at a post. And I'm looking over at my other screen here that we did after the first effort in 2009. And it's a post in the blog that was entitled Keys to the Castle. And I'm going to put a link in this post today to that. And we spent some time going over this late last week with the team. And it's important for a couple of reasons. One is that this was the summation of a team that had worked together for over 8 weeks. And it was my reaching out to them to say, okay, what have you taken out of this? What are the key takeaways? What are the key elements of all the time that we spent together? And it was 8 weeks, 40 some hours a week. What are you taking away? What is most important to you? And as you'll see if you read through the post, really a couple of things come into play. The first being market bias. We've talked a lot in the past week about bias, about the likelihood that the market is going to do A versus B at any given point in time. What is the bias of the market, given how it traded yesterday, given how it traded this morning, given how it traded overnight? I've said before that the market, although it's an accumulation of many thousands and thousands of traders and hedge funders and people trading different time frames, it's a living, breathing organism made up of a lot of different piece parts, and it has a personality. And if you're a specialist, if you're a market maker, if you're pit guy in the old days or gal, you specialize in one market and you get to know that well, and that's the intent of this. It's not jumping from one market to another. It's not diluting your focus, but it's staying with one market and understanding what is that market likely to do. I've said before that I view this as learning and actively managing inventory for a market, which is very much like your children. You know its personality. You know when it's tired. You know when it's cranky. You know it's when it's you got to stay away from it. You know when you should be aggressive. I've said this before, but it's very, very important because you have to understand the personality and what's likely to happen. And we call that market bias. And just reading from this excerpt again from this post, it says this was the most important lesson overall is this one little concept can turn your whole trading career around and make consistent profitability possible. And these are comments from those who were in the tank in a very in-depth manner. And I encourage you to read through this. The other point that was very important is that of outliers. Now, last week was an interesting market because we didn't have a whole lot of huge runs except really for the what we call the black swan late on Wednesday. I believe it was when the Greek news came out. And so outliers, we talked a little bit about their importance and their ability, our requirement to add to positions that are going in our favor, and really finding those couple of trade sequences over the course of the week where you can add, you go strong, and those are vitally important. So what we ended up doing over the course of the week is create mini outliers, which is basically where you are getting into a position, maybe one toe in the water or 1 foot in the water, and then you get that little bit of confirmation, and you go ahead and you add that extra position, and then you're able to trade a higher position, heavier position in your direction than you might otherwise have been able to. And those even those mini outlier pieces tend to add up over time. I've said before, I'll say it again, I can count on 2 hands of the thousands of traders I've talked to, worked with, whatever, the number of people that can answer yes to 2 questions. One is, do they always add to positions when it goes in their favor? And 2, are they always thinking about the person or machine or person running the machine that's taking the opposite side of their trade and what they may have to do if, in fact, they're proved wrong? All the time, every trade sequence. If you can answer yes to both of those questions and you're honest about it, then you're on your way. So outliers, again, you're getting more information that the market is doing what you expect it to do before it just takes off, before you get that, excessive confirmation that the retail crowd is waiting for. So you generate confidence, you get your position on, you're playing poker, you kind of know what the other hand is that you're playing against because you're giving it a bad card. Okay. So that principle is important too. So those are the real, if you had to boil this business down to 2 takeaways, which is a little bit of a stretch, but those are the 2 takeaways. So I encourage you certainly to read through that post. It remains valid. It will remain valid until time ends, because this business is all about market psychology, and it's about understanding and anticipating and being on the right side of that. So please take a few minutes to read through that. What else? We could talk for a long time. Mention a little bit of what I would call the black swan on the I think it was Wednesday, end of Wednesday's close. Market in a very, very consistent uptrend. We don't do a whole lot of trading, and I don't do a whole lot of trading after 2 o'clock, but I actually did, as the jellies know, I did trade that a little bit and stopped out. It was a bit of a black swan because you had a market which was uptrending on several key time frames that then gave way because of news that came in late, which in the long run we all knew was pretty lame. But the way the markets work these days, sell first, ask questions later, and markets certainly between all the algos and that kind of thing, just in a very illiquid time of day, just the bottom fell out. So stopped out on that, and basically were proved right the next day and able to take advantage of that, knowing that everybody was trapped south. Anybody who had sold long positions or were in new short positions had got stopped out. So certainly we're able to recover that on Thursday morning and understand the dynamics of that. But talked a little bit about that in terms of how to trade that, and talked a lot about the need to continue to understand that time, probability, and sample size is going to do the heavy lifting for you. So that there will be times when you get into trades that they don't work out because they're the lesser probability. But what you can't do is build your trading strategy around the lesser probability outcomes, even if you happen to be trading it and you're trading it profitably. If you can literally adapt to every single move, that's certainly one thing, and that is the goal of a jellyfish. Yet at the same time, if you're building a business plan to specialize in that sort of a sell right into the selling type of thing, it's somewhat dangerous, especially when you've got so much strong support on the other side. So we talked a little bit about the random results dilemma in terms of traders being reinforced by generating profits. They're being reinforced into trading incorrectly, as opposed to taking the longer view, larger view. And I think that's a challenge a lot of traders have, especially when they start the business, where like in a bull market, they'll just go long all the time, and all of a sudden, that'll work well. It'll work well in a bull market, but when the market changes, the market dynamics change, which it always will. Then they don't do well, and over the long run, they lose. I can still count on maybe two hands and 2 feet the number of newer traders, non-professional traders that made money during the internet bull run of the late 90s, early 2000s, that actually were able to keep it all, because they did well on the way up, but on the way down, what happened? Well, if something went from 10 to 200, great, but as the 200 becomes 150, becomes 100, they're buying on the way down, and before you know it, they're blowing themselves out. So again, the importance is to develop your trading strategy against that which provides the greatest probability. To the extent that you can get into an outlier and hang on to it, wonderful, and that's the intent. To the extent that you could do that in the context of the market, again, doing that more often than not in terms of a probability basis, all are much better. This is about trading high probability over and over again, and developing your business plan to support that higher probability. Talked a lot also during the week about AIR, the concept of AIR. If you go into Jelly Speak tab at the top of this blog, it talks a lot about the acronyms that we use. AIR, the visual representation on a chart between where price is and where logical support might be. And had several opportunities where you had that AIR. And if you look at Friday's close, now we closed the session at about 3 o'clock on Friday, but you look at Friday's close, notice how that AIR filled in the hourly and the 2-hour chart right down to support. And by the time the market closed at 4:15, and actually at 5:15 in the last session, we came off the support, and the AIR had filled. The larger time frames had taken over, and market. Monday, I'm certainly expecting that it'll be fluctuating a little bit, but Monday afternoon, Tuesday, just resuming that uptrend. At least that's where the market seems to be pointing at this point, subject to change. So a lot about the AIR, the midday AIR trades that we love taking on a wholesale basis. Those continue to be one of my 5 or 6 PJOs, prime jelly opportunities. Those which we can press, those which are extreme high probability, those which I still can't remember them not paying since this year started, certainly, and they're so very high probability. So continue to look for those, focus on those. What else did we talk about last week? We talked a little bit about, I could talk about the Super Bowl ad infinitum from a trading perspective. Most of you know that have followed me over the years that I kind of look at everything in life and realize that there are significant trading analogies there. And whether you are a Seattle fan or a New England fan or a sports fan or a non-sports fan, there's so many lessons that we can take away from that game as a microcosm of sports, as a microcosm of humanity, which is so very similar to this business. One of which I'll call the Black Swan again. If you go back to the Patriots, for example, back in 2007 and 2011, 2 games that from a probability basis they should have won. You play that game 100 times, they're probably going to win 98. But they lost 2. I'll give the Giants credit, certainly. But they lost 2 on 2 very fluke plays. One was the Tyree catch, where Eli Manning just basically closed his eyes, threw it up, and the guy was covered. But somehow, some way, the ball kind of got lodged between his head and his helmet as he was falling back, and never touched the ground. And the rest is history. The Giants went on to score and win. That was where the Patriots were 18-0. And then there was a second Super Bowl in 2011 where similar catch, not quite as dramatic, but still a very, very difficult catch that was made, and then a drop that was made by New England late in the game, which shouldn't have happened. So the Patriots ended up losing those games. And then we flash forward to this Super Bowl where, kind of the same thing was about to happen, where there was a dramatic catch, juggling catch, incredible catch very late in the game. Seattle was prepared to win the game. But then the Patriots had what I wouldn't call a fluke play, and you can question the decision-making from Pete Carroll all you want in terms of passing from the half-yard line. But, it was actually a play that was very low risk and from my perspective, made some sense given the context of the game at the time and time left, and Belichick not calling timeout and needing to stop the clock probably once. And And then you have this guy that was an undrafted rookie who just made one hell of a play and reading it ahead of time. He'd been coached on it ahead of time, reading it ahead of time, going for it, and intercepting the pass. And you could probably call that a bit of a fluke, maybe. Okay, but this person was coached on that, and so my point in all of this, again, no matter who you're rooting for or having some fun with in terms of the sports world, is that these are all outliers. These are all kind of crazy little things that happen. But they do happen, and you have to accept that as a part of life and accept that as a part of your trading. There are going to be odd things that happen that you have to prepare for. And the idea in this business certainly is to minimize the damage when those things happen. So that was one thought. Another thought I had was just the concept of longevity. And we could look at various sports and various teams that have done well over an extended period of time. And I'd be careful here because a lot of the world doesn't understand or disses the Pats, and I get that. Every team is trying to push the boundaries, and to the extent that you push the boundaries a little bit more than you should, then you should get penalized for it. Then just as you get penalized in a game if you're holding or offsides and that kind of thing. And we'll see where Deflategate ends up. Apparently, word has it now that Indy or Baltimore was kind of ticked off that Brady questioned Harbaugh's reading of the rules a few weeks ago, and they basically said, well, okay, if that's the case, we're going to call him out on it. So anyway, neither here nor there. You have to look at longevity, and longevity is so critical in the trading business. If you look at people in this industry that are successful over long periods of time, and if you look at the Pats, going back from the early 2000s to now 2015, extended run of success, and you're going to have people question that. You're going to have people basically not understand it. And I think what happens in this lifetime is that when people don't understand things, they tend to attack it. We talked about this in the class last week. And if you don't understand something, your first natural reaction is that you'll say, well, it can't happen, or it's happening, inappropriately or whatever. And I've faced that, and you probably faced that in your trading careers. I'm talking to the general population now, where if you try to explain this business, people will say, no, I don't understand. It doesn't make any sense to me. It's luck, it's gambling, it's all that sort of thing. And I go back to a conversation that I had with a trader several years ago where, this was 2009, where the first quarter I had 58, profitable days out of 61, very, very consistent. The dollars were very, very strong. And I've had other stretches like that as well. And the person couldn't believe it. He thought I was lying. I showed him records. He thought they were fabricated. And the idea was, they says, well, it must be all luck. And I just gave up after an hour because I was really trying to help him, and tell him that it was doable. And I said, well, then I must be the luckiest person on the planet from a trading perspective, because that's all you're going to accept. And my point here is that, understand this business. And if you understand this business, you're going to be in this minority. You're going to be in that 10% or fewer. So the vast majority are not going to get it. They're going to be in the business losing, and they're going to be questioning and challenging and saying that you cheat and you lie or you're lucky. They're not going to understand, and just accept that. Understand that, as someone said in our room last week, they're going to hammer the tallest nail. That's the natural tendency, especially in a world where we're trying to bring everybody down to a common denominator. And we could talk hours on the political front, but that, there's a tendency for people to do that. What I'd like you folks to do is focus on raising your lives up. Raising your lives up. And in doing so, we're raising the bar for everybody up. Okay? And that's the way that I'm trying to approach life. And I'm successful at times, and I'm not successful at other times. But the idea, instead of hammering down, is let's lift up. And I think that in life, that's just so vitally important. And anyway, that was another thought that came out of that. So markets, we talked a little bit earlier, a few minutes ago, the uptrends on larger time frames seem to be kicking back in. You've got to stay wholesale. You've got to make sure that as we said last week, if you don't get your wholesale entry, you can't chase. You can't chase. You got to let it go and either wait for a retracement on a higher time frame, or wait for a retracement on the time frame you are trading, but recognize that a further extension that you are trading is going to result in additional air on a higher time frame, so you've got to manage your outs on that fairly well, or just sit out the market, or manage a position from an earlier entry point that you're recognizing that excuse me, that the holding time frame is longer. So you know, there's so much in this business that we said last week. We all have a blank canvas, and it's up to us to determine what to do with that canvas. You know, there are so many ways that we can make this our own business and embrace it and enjoy it and manage it and make it our own. But there are also very common themes that we have to use, we have to share. Otherwise, the very principles of this business would not be applied, and over the long run, that we would be unprofitable. So, again, make this business your own, but recognize these core principles, the market bias, the outliers. That's what's important. Focus your time and energies on that, and then build your art around that, build your canvas around that, and you should have the best of both worlds. Last thought I will leave you with. It's been almost 20 minutes here. I appreciate your time this morning. And you know, this was something that I read in a devotional this past week, but I do believe this makes sense in terms of we are all at the very point in life where we were intended to be. We are exactly where we were intended to be. So whether we look back at past successes, past failures, recent successes, recent failures, recent challenges, current challenges, we are at this very moment in time where we are supposed to be. And my question to you and my question to myself is, okay, we have today, we have tomorrow. What are we going to do with that? What are we going to do that in our trading? Or what are we going to do with that in our trading? What are we going to do with that in our life? Okay, we have this gift of today and tomorrow. Let's maximize it. Lift everybody up, all right? Don't hammer the nails down. Lift everybody up to where we're trying to strive to be, and in doing so, that we'll be in a better place all around in business and life, and more importantly, far beyond that. So, that for the day. Have a blessed rest of the weekend. Have a great trading week. Thank you for the continued feedback. We'll keep up with this. That's all I have for now. Take care. See you later. Bye.